All right, well, thank you all. Thank you all for being here. I know we've got a number of really interesting conversations going on at the same time, and so we're so pleased that you're here. We're going to try to make this a bit of a conversation as well as a presentation. We do welcome anyone to come to the front if they want to. Perhaps we can take questions as we get to that time without mics. Again, thank you for being here. I'm Sarah Cohan-Williamson. I am the CEO of Focusing Capital on the Long Term. And I think as we think about this conference and the arc of the conference, what we wanted to talk about today is particularly the role of incentives as they relate to capital markets. And we've seen, I think already in this conference, the quote from Adam Smith about the butcher, which said it's not the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but in regard to their own self-interest. And that is what we're thinking about today as we think about why do markets work the way they do, and what role do the incentives have in making them work in that way. You can read everybody's bio on the app, but this panel is uniquely positioned as people who have deep experience in capital markets as practitioners, at least as part of their background. So I and all of my colleagues here have spent a long time actually being in the capital markets. And so what we think of as our job today is to tell you a little bit about the way we see things really working, what really happens, welcome your questions and comments on those, and then to try to take upon ourselves a bit the question that's been raised many times, what can we do? What can we do from a practical, action-oriented point of view? So what we're going to do is each member of the panel is going to just take a few minutes to introduce a few thoughts, and then we're going to ask some questions back and forth that I have for the panelists, and then we're going to ask all of you to ask questions. So that is our plan. So just to get started, quick introduction about Focusing Capital on the Long Term. We are a not-for-profit entity that is trying to rebalance capital markets to be longer term for the benefit of society as a whole. So small little problem, we're trying to fix capital markets. Why? Because effective long-term capital allocation is critical for economies and for societies, because we think we can change the behavior of the markets, and because it's better for investors and companies and communities to be longer term. So how do we think of, why is this an issue? In the spirit of what really happens versus what should happen. What should happen, why do we have capital markets in the first place? Why did they work back in Adam Smith's day? Was because at the one end of the spectrum, there were savers, people who had money that they didn't need at that point in time. They needed to put it to use for something in the future. Perhaps they're saving for the next generation, their retirement, whatever it may be. At the other end of the spectrum, you have people who have ideas. They want to build a new product, enter a new market, create a company, something like that. Usually a long-term use of the capital. So sounds easy, right? Long-term source of capital, long-term use of capital. Capital markets are meant to efficiently allocate them from one to the other. But the way that the markets work today, which of course is different than at Adam Smith's time, is that most of that savers' money goes to big asset owners, people who are pension plans, sovereign wealth funds, other very large asset owners around the world. Most of that then goes to asset managers, fund managers who manage the money on behalf of those asset owners. And then most of that goes through the publicly traded equity capital markets to the company, which then eventually allocates it to the project. And in that process, those long-term sources and long-term goals typically get lost, and the short-term incentives of the markets take over. So why is this a problem? The problem is that, and we've done quite a bit of work on this, which we can share. Most directors think that they are put under pressure to perform within 2 years. We can argue over what long-term is. 2 years isn't long-term. And they think they would make much better decisions if they took a longer time frame. As we've already talked about some in this conference, much of earnings are being paid in buybacks instead of reinvested. We can talk about that in more detail. But the most striking number to me, this is a McKinsey figure, is this number that 55% of CFOs of large companies actually admit that they would forego a positive project, forego a positive NPV project, if it meant missing their quarterly earnings by a penny. So they know this is not an economic decision. They know that they are making a trade-off. And the reason they are making that trade-off is because they feel they have to because of the short-term pressures of the markets. So what we're trying to get to is not that short is bad and long is good, but that there is this friction between what people believe they should do and what they actually do. So how are we working on this? We'll come back to this in terms of what to do next. We think that there are a number of levers. Governance, we've talked about a lot in this conference already. Incentive alignment, that's what we're talking about today. We think that engagement between investors and companies is extremely important. Strategies that lead to long-term investments in talent, innovation, capital allocation, risk management, very important. These are things that take a long time to come to fruition. And we think, at least, of public policy as the backdrop to this, that it can create the right environment. It's not necessarily a solution. So hard to see on here, but the idea is to have a virtuous cycle of savers' money going to asset owners, asset managers, companies, and benefiting communities and supported by policymakers. So with that, let me stop and ask George to offer some opening comments.
Thank you. So my perspective on this is that you need to see markets, in particular the capital markets, in their historical context and in light of the purposes that they're intended to serve. And these purposes have changed dramatically, and the structure of the capital market system was designed for something other than it does today. The original purpose of the stock market, these kind of capital markets, was to raise capital for economic opportunities that were too big for individuals and partnerships to fund directly. Whether you're thinking of taking over India or building a railroad or something like that, you had to get much more capital together than the four of us in a room could muster. And that's how these stock markets began, but they were, the investors in them, it's true they were savers, but they came from a very, very small proportion of the population, the only people who had any money. They didn't have diversified portfolios. They put their money into specific things. And for example, in terms of governance, the concept of oversight by a board elected by this small number of relatively well-off people made some sense. Today, this is not the primary purpose of stock markets. The venture capital industry, the private equity industry, the retained earnings in large companies which have oligopoly power, these are the sources of capital that really go into growing new businesses. The main function of the capital markets today is something completely different. It's to be a key participant in the creation and management of the savings of a mass of what we can call ordinary people. There's a subsidiary function which I'll return to, which is to provide exit routes for people who know more than the others, but we'll come back to that. The structural implications of management of mass savings are enormous. Broad diversification of investment to manage risk. This is absolutely the right strategy from a wealth protection point of view, but it carries enormous implications for what actually happens in terms of market control of companies. The growth of very large investing institutions is another consequence of that change to this completely different function. It's much more efficient for large institutions to allocate capital than for all but a small number of wealthy and well-informed individuals. What results, of course, is portfolios holding thousands of investments on a global scale, implying the impossibility of individual investors or even large institutions knowing much about the operating practices or market context of almost all the companies in which they are investing money. We all hear about, we heard yesterday about, attempts to break up GE and so on. GE's one stock. There are thousands and thousands of stocks in the portfolios of all of these investors. No one's focusing on these at the level of these asset owners. This switch in function, while keeping the existing structure of trading shares, of boards of directors, of this kind of old-fashioned ownership, has some very bad consequences. We can list a number of them. One is that, of course, this institutional holding, often very passive holding, leaves lots of opportunities at the edges for opaque operators like hedge funds and private equity funds to cherry pick investments. And it also enables them to sell investment concepts to individuals and institutions who have no ability themselves to carry out the due diligence that's required on what's being sold. This complexity issue affects even the largest institutions, as those of you who are familiar with the cases of Sino-Forest, one of the most hilarious of investment scams, and more recently Theranos will understand. There's room for a dramatic skim of individual investors because the differential information between investment advisors and investors is very costly to bridge. I don't want to go through all the kind of advertising that investing institutions do and all the rest of it. You know this. Separation of ownership and control, it's long talked about, but it's an obvious consequence when the owners, so-called, have thousands of shares, tiny shares in thousands of companies. What do you expect, except that the management de facto control everything? The proxy firms that provide information on voting on who's to be on the board. I ran one of these businesses. The regulators forced me to sign up, and I hire one of these proxy firms, and I tick all the boxes, and the regulators say, good boy. But this doesn't constitute effective control by owners of any of these entities. A very interesting question, the second level of cartels. We have now a case where very large investing institutions hold shares in all the competing players in oligopolistic industries. Very interesting academic discussion of the US airline industry, which turned from perennial losses to amazing profits once the four biggest institutional investors in the world ended up owning very substantial chunks of all of these airlines. It's not in the interest, and this is very important to understand. An individual is both a saver and a consumer. The saver's interest is for the oligopolistic companies to make as much money as possible and pay it into their pension pots. The consumer's interest is exactly the opposite. This is one of the many contradictions that emerges from this situation. This second level cartel question, I think, will become more and more important as more and more industries are turned into oligopolies. And finally, of course, regulators are present, but I believe they will never be adequate controllers of these situations. They have neither the salary budgets nor the data and the systems that the large investing institutions and the intermediaries have. So it's better than nothing, but it is impossible to actually do this. One of the US regulators, in fact, commissioned McKinsey when I was there to do a study of how they could be more effective regulators, and we told them in a nice official McKinsey document, for the exact reasons I've given, that it was impossible. Other consequences, the uncertainty inherent in predicting the future, which is what investment is, it's placing bets on the future, means that the customers aren't very well placed to understand long-term strategies or to stick to them. If a company says it's going to do something, how do you know it's not going to be one of the stupidest things ever done? How do you work that out? And the result is that people tend to be very suspicious of long-dated promises, and they make judgments based on what they can see, and they make judgments based on rules of thumb. I can tell you in the investment advisory industry that I was part of for some time, one of the most common strategies was to follow the smart money. You can figure out the volatility implications of these kinds of rules. There is a lot of volatility in these markets. In technical terms, the probability distribution of prices is not stationary but dynamic, and it's in fact endogenous. As people's beliefs change, things actually change in the markets. And so when you try and follow risk management rules, they don't work because you're using yesterday's probability distribution. You may remember in the financial crisis, an executive of Goldman Sachs said, gosh, this is an event that should only happen once in 50,000 years. This is an extraordinary statement, but it's a reflection of the underlying reality. And of course, this volatility means that the people who are on the inside, the people who are doing IPOs, the people who are selling holdings out of private investment companies, when do they sell? When do you sell something? When the buyer's willing to pay more than you think it's worth, yes? Well, who knows what it's worth if not you? One of my other jobs, I set up a business that helped private equity firms dispose of companies that they held. Insiders make a lot of money from trading. I used to tell my clients, if you want to invest in an IPO, wait a year. They're almost always cheaper 12 months after the IPO. That's because the insiders have timed the selling according to their concept of value. So fine, what's to be done? I've rattled through this in the bullet point form. I think the first priority of reform of the capital markets has to be to protect the savings of the mass of the population. Protect the savings from bad investments, protect the savings from skim. This has a huge impact because in our Western countries, essentially savings that you make yourself are the most important component of your likely retirement. And one suggestion I'll make, and then I'll stop, is that we should seriously consider following Singapore and Australia in introducing compulsory saving schemes. You know, you either save money or they tax it. It's not a hard choice. And limit the vehicles in which these savings can be invested. If you look at what's happened in these countries, while you can debate a lot of things, you do not have in Australia, for example, a lot of people like in the United States who have essentially totally inadequate savings for their retirement. They're forced to do it. This is simply an extreme version of these nudge things, you know, opt out rather than opt in. When you're talking about money and long-term savings and long-term behavior, you have to do more. And we could think of more of these things. These kinds of actions aren't going to solve the problems of information differentials and other issues in the capital markets. What we should seek to do first is to take some of these risks off the bulk of the population who actually depend on these resources for their retirement and their long-term futures. And we can talk also about regulation, but I think we have all seen regulatory capture and these other issues of limited resources. I don't think we're going to get much better regulatory behavior than we have now. I strongly endorse the notion of breaking up oligopolies, of trying to increase competition, because that reduces the opportunity to exploit the information differentials which are inevitable in the system we have. So those are some thoughts for us to start with.
Thank you very much. It's a pleasure to be here. And I guess I'm the gadfly. I believe if managers are thinking short term, they should stop doing that. I don't think the market's to blame. And here's just some basic data for that reason. I've picked out a few companies here. There are many others I could have used. But let's look at a couple. Let's look at Uber. Everyone's focused on the last quarter or last year, right? Well, last quarter, Uber lost $1 billion. Last year, it lost $2.8 billion. It's never made any money, and its market capitalization is $72 billion. So the market is not looking at the next 12 months, the next quarter. It's not even looking at the next 5 years. It's looking at the hereafter to value this company. And there's nothing unique about Uber. Lyft is the same way. Roku, Snap, Wayfair, Shopify. Shopify I find particularly interesting. It's continued to lose money. It's a Canadian company. Lost 36 million last quarter, 92 million last year. Its stock is up 125% this year. And its market capitalization is $35 billion. This doesn't look to me like a market that's focused on the short term. And here is a company that in the short term does really well. General Motors. Over $1 billion of profit last quarter, $2.7 billion last 12 months. It hardly sells for more than Shopify, and it's not worth anywhere near what Lyft is. I mean, what Uber is. So I think you need to take this with a grain of salt when you say that the markets are short term. My second point, my sons run a small investment advisory firm entirely focused on the long term. I'm their senior advisor. We base our investment decisions entirely on long-term discounted cash flow valuation. But people say, well, you respond to the short term. Well, here's the problem. Information only arrives in the short term. Tomorrow's information is unknown speculation. Yesterday's information is stale and out of date. The only thing you can respond to is what you learned today. So it's very difficult to tell when you're responding to short-term information. Is that because you have a short-term outlook? Or is that because you have a long-term outlook and you're revising that outlook? In our case, it's the latter. And I think, given the way these companies are priced, that's also the case. Now, here's a little further data, not company-specific, but market-wide. This is Bob Shiller's adjusted price-earnings ratio. And you can see right now it's at an all-time high, except for the tech bubble and the 1929 bubble, of about 30 plus times, that means the market has got to be looking at earnings very distant. Otherwise, why would you pay $30 for a dollar of current earnings? Now, the final point I want to raise is a little bit of a different topic, but it's been constantly discussed throughout this conference, and Niall Ferguson brought it up during his presentation, I think a little unfairly actually to the Chinese, but this is how are we going to finance a civilization of 10 billion people that is going to require massive amounts of energy to live the lifestyles to which we've all become accustomed. And here I think is the most useful data in that regard. I know this chart's a little busy. Let me explain what it is. I've taken total energy usage, total primary energy usage, of which about 85% is carbon-based fuels, and I've converted it to kilowatt hours per day per capita. So it's kind of how many kilowatt hours does our society use to keep people living it the way they're used to living. And here it's plotted for various countries. This is the United States. You know, remember Niall said the United States was being very effective in cutting back on its CO2 usage. It's a little bit like saying that someone who is massively overweight has an easier time losing weight than someone who is skinny. Because down here is China, and China was until recently pretty skinny, and this is why they're having a problem with CO2 emissions. They're trying to rise to what I call the European standard. That would be like Germany and the United Kingdom and Japan. They're all here in the middle, the US at the top. And then finally down here you have Africa and India, which have the largest and fastest growing populations, and they're at less than 15 kilowatt hours per day per capita. Those people aren't going to want to live that way forever. If they even aspire to the European standard, the total energy demand is going to rise substantially. So a massive challenge for the capital markets is how are you going to raise, in the long term, tens of trillions of dollars to solve this problem? And I think it relates back to the debate we were having of the US versus China. Will the US and the Western European countries figure out a way to finance and solve this problem? Or will it take a centrally organized, directed government of the type that China has to do it? So I see this slide as being really the biggest long-term challenge that we face in the world and in the capital markets today. Thank you. Lynn, if you need slides.
Great to go. Hello, everyone. Thank you, David, and thank you to the university again for hosting this conference. I confess again, I am not an academic. I am an activist, and that's really why I'm here to talk with you. How do I get this? Oh, there. Okay, as an activist, I fell into something I didn't anticipate, which was I became the founder of the Coalition for Inclusive Capitalism. And that was simply a group of people responding to the financial crisis and what we thought was the political and social fallout in 2009 and 2010, and could never have anticipated where we are now in 2019. But we did come together to talk about how, first of all, capitalism has been the greatest force for good in the history of mankind. Second of all, if we don't admit that we have gone wrong, and if we don't face that and change the way we do things, capitalism is at risk. Capitalism is basically not too big to fail. And the corporation was not created by God like he created us. The corporation was created by society, and we have a social contract. Society lets us exist and have our limited liability as long as they believe in us. And all of the evidence is they're believing in us less and less and less. So what do we do about it? And I think that's why I love this conference and that we're here. So I think what's important is we go back to basics. So we talk a lot about Milton Friedman's 1970 letter in the New York Times, which, by the way, it will be, of course, its 50th anniversary next September. So David, I'm counting on you to do something really bold in connection with that anniversary. We all need to step up our game for that anniversary. But it wasn't, as I said yesterday, I mean, wasn't just a phoenix that grew out of the ashes. It had been a philosophy that had been brewing among thinkers for a long, long time. And in 1962, I think there's a more relevant quote from Friedman in Capitalism and Freedom in 1962. He said, "There is one and only social responsibility of business, to use its resources and engage in activities designed to increase its profits so long as it stays within the rules of the game." That's like the most straightforward thing in the world. So what are the rules of the game? And I think what we have to come to grips with is how we're going to change the rules of the game. And just to take, John talked about these two companies yesterday, and we've talked about them in every panel, at least one that I've been involved with. But let's take Jack Welch, the iconic CEO, the one everybody looked at. Jack Welch, Warren Buffett, these are gods, right? And Jack Welch was a total proponent of the Friedman idea that his sole obligation was to produce a profit. He had what he called, very bravely, he very openly said he has a rank and yank system. Every year, 10% of the workforce goes. It just goes. And people thought that was great. And Jack Welch could always promise what his earnings would be. In 46 out of 48 quarters, he never missed his earnings target. In 41 of those 46, he got the target exactly on mark. During that time, that really worked out really well because the company grew that's the period of Jack's growth during that time. It was an unbelievable expansion. He grew from 14 billion to 410 billion. Quietly during that same period, J&J grew the same. J&J is the red line, almost a little better than Jack. And they followed basically the credo from 1947. I long for the 50s without the misogyny and without the racism. But their credo, and I did say it yesterday, our first obligation is to our customers, the doctors and nurses who provide our services to sick people. Second, to our great employees who make that possible. Third, to our communities that allow us to operate. Fourth, a, quote, reasonable return. This credo, if you go to J&J's headquarters, is ingrained in a piece of granite in their lobby. But the interesting thing is what happened after Jack left, okay? There goes GE, and there goes J&J. GE is down by 80%, J&J is up. So so that is also why Jack Welch in 2009, long after he was gone, called maximization of shareholder value the, quote, dumbest idea in the world. So everybody can put that one to bed. The question is, what do we replace it with? And I love the idea of long-term investing, but long-term for what? You could be a long-term investor in guns and tobacco. And I think it's wrong to say that people don't invest for the long term, a little bit like was shown before. People invested in Amazon for the long term, knowing, as we heard yesterday, Jeff said very clearly, if what you want, oh, that was a small panel, maybe you weren't all there, it wasn't a plenary, but the person read from the statement to shareholders. If you're looking for a short-term return, go find someone else. This is exactly what Paul Pullman said to his shareholders when he took over. He had a shareholders meeting and he said, for those of you who care about the short term and don't care about my agenda, of taking care of our employees, securing our supply chain, being good citizens of the world, go find someone else. And it was really interesting what happened to him, because when 3i and Kraft Heinz came in to take him over on a Friday, his board stood with him, but he knew that shareholders, even the ones who talked about a great long-term game, half of them would have taken the premium. So the question is, what are we investing in for the long term? So all of us, and this has changed a lot since the Coalition for Inclusive Capitalism started, where we believed that we had to have a broader stakeholder model. Today, there is, by most accounts, $13 trillion invested in ESG. And that's really important. Who is making the investments? I don't think that we can look at CEOs and expect them to take care of their employees and take care of the planet and take care of their communities if we're not willing to invest in it, and if we're not willing to maybe sacrifice something for the short term. American Airlines, about a year ago, declared that they were going to give an increase to their employees a year earlier than the labor negotiated contract required. They decided, we want to share with the employees. The headline was, American pays its workers more, Wall Street goes nuts. What CEO is going to do that? I mean, you kind of have to be suicidal. So I think looking completely at the companies is not right. And focusing capital on the long term does this also, which is you look at the asset owners, the asset managers, and the companies, and how do they all work together? How can you create a race to the top, not only for society, but also for shareholders, like J&J. You sure, if you were a long-term shareholder, wanted to be a J&J shareholder for the 30 years that you were there. So I spend a lot of time working with asset owners on what do you really believe in? Are you willing to put your money where your mouth is? Oh, and this money, I forgot about this one. This is a study that Bob Eccles and George Serafin did in 2010, so it is dated, but the information is directionally still correct. They showed that $1 invested in 1992 in companies that have some sort of inclusive, sustainable agenda would have been $22 at the end of 2010, and a portfolio that didn't care about these things would be 15.4. So there's a very good argument that investing in your people, your planet, your community, your brand, your reputation, innovation of good, safe products, like Peter Drucker said, to find a product that people love is a good thing to do. And then this is a survey that was done of the institutional investors, because I really think that is where the rubber hits the road. So we have this term ESG, which most of America thinks is a disease. It's like CSR, ESG. It doesn't mean anything to people, but it means something to us. We know what that means. And so those institutional investors have a fairly good gripe that particularly the second one, that there aren't standards to measure ESG. And if you can't measure it, you can't really expect people to invest in it. And I think that's a very, very legitimate big hole. If what you care about is return on invested capital or earnings per share, you know those numbers are standardized, they're audited, they're good. But what do you do about how can you measure, is Coke or Pepsi better with water? Is IBM or Microsoft better with its employers? Is Tesla cleaner than somebody else? You can't really do it. So the coalition, again, we are activists. We partnered in 2016 as a result of a meeting with Paul Pullman, because we have CEO meetings, and we met with Paul in his office on the Embankment in London. And Paul told us that he didn't believe all of his shareholders would support him, so it was very important that Buffett pulled the deal because he wasn't sure if he would win it if they had pushed into a proxy fight. So it was very fortunate for us because one CEO who was there was Mark Weinberger from EY, and Paul Pullman said, my investors can't really measure what I do with my people. They can't really measure what I do with my supply chain. So, EY committed to work on a confidential basis with the group of CEOs who are part of the coalition. And we put together this group of 32 plus an advisory council, but divided among owners, managers, and creators. And for 18 months, there were confidential meetings among on the asset creator side, we felt we had to be sector specific. So we had health, you'll see here, health, industrials, and consumer goods. But we met on a confidential basis, we being very much EY, who made an incredible commitment to this, to work on what are those factors that a company believes, number one, creates value for society, but not even number two, equally creates value for shareholders. And they were able to put their metrics together and design a list of value creators. And it was, although it was 18 months, we sort of scraped the surface in that we were able to get agreement that innovation, governance, environment, and talent, and community are 5 value creators. Because every CEO worth his or her salt knows that having a brand that is loved, having a place to work that people love to go to and are proud of, having respect in the community is their great value driver. So it's not rocket science for them, but how do you translate it? So our task was, let's come up with some measures that could be standardized and comparable. And at the end of the day, and we announced in November 2018 that we had specific metrics only around talent. We couldn't figure out and agree how you measure trust or how you measure culture, but we did agree on talent. And the list was put out, and most importantly, these 32, with 1 or 2 holdouts, signed personally and a page in the Wall Street Journal that they commit to working further on these issues as value creators for both society and for their companies. And so this butcher-baker thing of Adam Smith, it's not just about self-interest. I mean, we have to understand that interest in our employees and our planet and our community is the way that we create value. And what we need in this reformation of the capital markets is a race to the top on these things and be like the JNJ to GE comparison. Thank you.
Weijian Shan. It's a great pleasure to be here. Thank you, Professor Thies. First of all, I'd like to make some self-introduction. I'm a private equity investor. I'm head of a firm by the name of PAG. We manage about $30 billion, and we focus mostly on buyouts. So we are dealing with this issue of long-term, short-term, what time, all the time, every day. And let me give you an example to illustrate the complexity of the issue that we're dealing with. We bought Lexmark, which is a printer business in the United States, in November 2016. for about $3.6 billion. So it's pretty sizable transaction. And we immediately were faced with this long-term, short-term decision. A printer business is very similar to razor business. Gillette, so forth, sell razors. When they sell the razors, they actually lose money. And they make money by selling the blades, the razor blades later on. So in printer business, when you sell a printer, you lose money. And you make money by selling the consumables, the cartridges, the paper, and all that. So it's a trade-off. If you want short-term profitability, then you should stop selling printers. And you should just sell the consumables. Then your profitability goes up for that particular quarter. But if you keep doing that, the installed base that you have will go down or will stagnate. And therefore, there will be no growth, right? You don't have enough printers to sell consumables to. So when we first took over the company, then we decided that this company, when it was a public company, underinvested in the installed base. For about 17 years, they didn't really sell enough hardware, that is the printers. And therefore, the installed base was stagnant, was shrinking. And so we decided that we need to start to invest to increase the installed base. And then the CEO overdid it to such extent that for that particular year, we are a $300 billion EBITDA cash flow business every year. And for that particular year, EBITDA became almost negative because they oversold the hardware. And that almost drove the company into the ground because we're levered. We owe money to banks. So we had to replace the CEO and we have to recalibrate our strategy. So that's a complex question, how you balance between short-term and long-term. We have to invest for the future, but at the same time, we have to be profitable. We have to generate a positive cash flow in order to survive for the future. So it's not a simple question of whether long-term or short-term, and you have to think very carefully about where the balance should be. And when I think about Adam Smith, when I think about invisible hand, when I think about how the wealth of the nation will be maximized when everybody pursues his personal self-interest, then this is something that we in private equity find very difficult to work in practice all the time, every day. Why? Because we see too often that there's a conflict of interests within the same organization. How much profit do you make and how much compensation do you give to the management, to the employees? And there's a constant conflict. And we have a policy. We invest throughout the Asia and to some extent outside of Asia as well. And we invest a lot in China. We have a policy that we don't invest with a state-owned company unless we're the controlling shareholder. Why? Because our interests are not aligned with each other. Why does a state-owned company not work? That is because their interest, the state, and the interest of the management are not aligned with each other. And we, a few years back, bought control of a bank in China called SDB. And we spent about $150 million. We became the only investor to have controlled a nationwide bank in China. And that bank was almost broken. And it was a problem bank, but we turned it around. And in 5 years, we sold the bank for our stake, $2.4 billion, from $150 million to $2.4 billion. And what did we do? We simply aligned the interests of the management with those of our own. And that is, if we're profitable, then they get stock options, they get part of the profit. And I think that the problem with this invisible hand in the marketplace is there's a lot of market failures that you will have to fix. The biggest market failure is the misalignment of interest, misalignment of incentives. So what private equity does is to, at least we try to, align the interests of the shareholders, the management, and the employees. And that's how you maximize the value of the firm. And there is a classic agency problem between shareholders and management. Sarah just referred to McKinsey's study that for 1 cent profitability in 1 quarter, management may forego the profitability in the long term. And we can't allow that to happen. In the United States today, there are twice as many firms controlled by private equity as public companies. And this is a very new phenomenon. Why that is the case? I think that is because you see this misalignment of interests between shareholders and management. Management would profit, would get paid more by focusing on quarterly results. Whereas from the shareholders' point of view, you need to see the long-term profitability of the firm. How do you fix it? You privatize it. And then you have a shareholder who can design an incentive system which align the interests of the shareholders and the management. And that's what we do. So that's one thing I would like to say, that the agency problem will have to be fixed. And there's also the issue of market failure when it comes to very long-term projects. And for example, China in the past 10 years has built the largest high-speed railway system in the world, 30,000 kilometers. That's very large network. And no private sector will be able to make that kind of investment. But in the short run, it may not be a profitable investment. In the long run, it certainly would be very conducive to the development, economic growth of that particular country. I live in Hong Kong, and right next to us, the government built the longest bridge, 34 kilometers, called the Bay Area Bridge, connecting Hong Kong with Shenzhen with Zhuhai. And daily traffic today is less than 5,000 vehicles. So it's hugely wasteful, in my view, infrastructure projects. But in 10, 30 years, maybe it will create a great Bay Area economy. We don't know. But it cannot be measured by short-term profitability. It is not something that the private sector should be bothered with. That really belongs to a government spending. Now, the final point I'd like to make is very often long-term is not necessarily good. I think if you look at the Chinese system, which I maintain is a system that's evolving in the direction of the market and has been doing so in the past 40 years. And the problem with China is it has not gone far enough in the direction of the market, and the state-owned sector remains too large. And the state-owned sector, representing about 35% of the economy, is massive, inefficient, and very wasteful. And the problem is that the government is unwilling to get out of some businesses when they should. When they sold SDB, the bank, to us, and that was the right decision. It was a state-owned company sold to a private investor or private investors. And so when they don't do that, and that creates a lot of inefficiency in the system. I have a friend in Taiwan who controls a conglomerate of businesses. And he complains to me about some of the businesses that he owns, his family owns, textile business, cement business, and all that. So I said, Donald, why don't you just sell your textile business or your cement business or your refiner business? And he says, we never think about that. This is our family business. We have been managing this business for the past 50 years. We don't think about it. I said, I'm a private equity person, and my goal is to maximize the value of my investment. And sometimes a business is a good business, and sometimes it becomes a bad business. If you look at the history, I think the first speaker of this event on Monday, John K. He pointed out that in the past 20 years, what were in the Fortune 500 companies, maybe 40% of them disappear, or 20 years, 40% of them disappear, because the market is dynamic, the market changes all the time, and there's a reason for you to look at your portfolio and get out when the time is right. And very often, a family business makes a mistake of holding on to something for too long, and to their detriment, because eventually a business may not be a business that can survive in today's market, because the market has changed. So my basic conclusion is that we need to address the market failure in one important aspect. It can't depend all on the invisible hand. And because there's an agency problem, there's market failure, and therefore, in order for the market to determine what is the best term that you hold a particular business, is for you, to the extent that you can, to align the interests of all the players to drive the maximization of the value. If you're not able to do it, you should get out of it. If you are able to do it, then you should try everything possible to align the incentives and interests of all the stakeholders. Thank you.
I have a lot of questions for my fellow panelists, and then I hope you all are thinking of some too. I think that this whole conversation is going around the issue of how do you balance people's incentives over different periods of time. So some people may have a short-term incentive, some have a long. There may be a conflict between management and the board, or between employees and shareholders, or there may be a conflict between what's best for the company and what is best for the environment. So thinking about how we make those trade-offs and how we actually align those incentives, if we come back to our friend Adam Smith and the butcher, those incentives were probably pretty clear. We were talking about one person selling something who probably didn't have a lot of other players in that chain. So maybe George, I can start with you, which is you talked about the initial setup of many of these markets as funding railroads, as being a small number of wealthy people who were getting together to fund an enterprise. Their incentives were actually pretty closely aligned. They knew each other. They had the same time frame. They were very close. That is not that different from the way that Shan was describing private equity today. Do you think that the only way to sort of square the circle in terms of the incentives around long-term is to get things out of the public market that really require long-term funding? Or do you think that there is a way through incentives, through the public markets, to have the public markets fulfill that duty?
Well, again, I want to say what I started with. We have to look at the function of these markets altogether. I completely agree with these comments on private equity and how you run a company and align the incentives. But what I started out by saying was the entire big picture purpose of these markets has transformed itself from either the raising of money for new ventures or indeed improving the quality of management to being an integral part of the retirement funding system of the entire nation. This is a different issue. It's a macro issue, and there is a micro issue. What do you do with a specific situation? How do you operate something better or worse? And it's very easy to focus on one and not the other. I made the point that from an investor's point of view, including the saver, a really successful oligopolist that screws as much money out of the market as possible and pays it out to those savers is wonderful. But if you're the person buying the product, you're being screwed as a customer at the same time you're being rewarded as a saver. This is an intrinsic part of this system. This is not a resolvable contradiction. And so if you go to the opposite extreme and you say, okay, we have this highly competitive system and there are 100 butchers on the street, none of them makes a penny. It's great for buying meat, but if you've invested in the butcher shop, what you're going to retire on? You understand? This system has to be seen in its totality. And micromanagement of individual enterprises, that's absolutely true. That's all about the alignment of incentives. How that corresponds to whether, my retirement is going to be adequate, the income I get in my retirement is going to be adequate, that's a different question. These markets are being used for different purposes. For some purposes, the micro purposes, we buy and sell things, we decide what to do, we move things from one owner to another. That has nothing much directly to do with whether, in the case of the United States, 100 million people should be participating in this process, either directly or through investing institutions. What I'm trying to get us to focus on is that we need to say there are many issues. Some of them are around how to run a company well, and some of them around how to fund the retirement of the entire country. These things are conflated in the capital markets. I couldn't agree more. I was an investor in ventures, in private equity things. At that level, the micro level, yes, the purpose of the market is to enable you to change ownership, to align incentives, to give out rewards that make people do things. Again, what's that got to do with your retirement? Nothing. In fact, the incentives in the retirement system are absolutely perverse. The people who manage these funds, I had a lot of dealings with institutions like teachers' pension funds and firemen's pension funds, okay? These entities were willing to invest in private equity funds and things like that. Their employees are not getting a share of the profits. They're getting paid $50,000 and they go home at 5 o'clock. The quality of due diligence they do on these investments is appalling. So there is misalignment of incentives throughout this whole system, not just at the direct management level of an individual company. But if you want to focus on how to run a retirement system for the community, you should say, how would I design that if I had a blank sheet of paper? And I don't think you would come up with what we have today. And that's a different question.
So Lynn, maybe I can come back to you in terms of this trade-off question. So a lot of the times in the ESG conversation, we get two different schools of thought. One is that companies need to be more altruistic, less worried about their own self-interest, do the right thing for the community or the environment because it's the right thing to do. And a different school of thought is that if you do the right thing by your customers and your supply chain and your community and so on, and you have enough time, it's actually in your own self-interest. So do you think that we can accomplish some of the goals that you've been talking about by using the self-interest argument to get people to extend that time frame and think about their own self-interest, or do you think we actually need to have people to do something that is altruistic?
I will answer that, but because the briefing was about this intermediary question, I want to answer that question because I think it is fascinating and it's really important with respect to pension and funding the retirement of every fireman and every teacher and every nurse, okay? So they really have to get it right. And I'm sorry, he's in the audience, I don't mean to embarrass him, but in 2008, John Kay wrote a column that I give to everyone who works for us in our family office, where, I'm gonna just read it, sorry, John, okay. Albert Einstein supposedly observed that the most powerful force in the universe is compound interest. During Mr. Buffett's tenure at Berkshire Hathaway, the S&P 500 index has produced an average total return of 10%. This is 2008. That return, invested over 42 years, will multiply your stake 67 times. But if your investment yield twice as much as that, as Mr. Buffett's have over his tenure there, your wealth increases not twice 67, but 67 squared, a factor of 4,500. That is what made Mr. Buffett the richest man in the world that year, but I go on. The calculation illustrates a more subtle point. Mr. Buffett's fortune has come not through growing an investment management business, a private equity fund or anything else, but from his own share in the value of the funds he manages. Suppose he had adopted a more conventional investment management structure that every pension fund goes into because of what you said, They make 50,000 a year. They don't know how to invest 400 billion. So they go to a fund, charging the 2% management fee and 20% of performance common in private equity and hedge funds. How much of that 62 billion wealth would have been the property of Buffett the manager, the GP, the Buffett Investment Management, or Buffett the investor, the Buffett Foundation, the LP? The answer is astonishing. At 2 and 20, the split is 57 billion for Buffett Investment Management and 5 billion to the Buffett Foundation. I mean, we worry about, this is just incredible math. And this is why, pension funds underperform. Because how do you pay that kind of money? Why are all the general partners of these private equity, they're the billionaires. What about the teachers and the lawyers? So, sorry. I think that the fund business is a terrible structure for, if we really believe that it's our duty to deploy the kind of deploy our money for the benefit of the beneficiaries. And Canada, I think, has gotten it a little bit better, a little bit more correct. So the head of the Canadian pension fund, he makes millions and millions. It is a he, and I think it's always been a he. But Mark Machin, well, yes, Mark and Mark Wiseman, who was there, they make millions of dollars a year, and they make their own choices. CalPERS has gone to the same thing. So the intermediary question is a really, really important question, and I thank John for that. So to your altruism, sorry. And if we're going to change stuff, we have to have these conversations. And 2 and 20 doesn't work. So it works only for the general partner, mainly for the general partner. On this altruism question, I don't think of companies that take care of their employees and their, the planet and their communities as doing it for altruistic reasons. I think that it is wise long-term management. So I really don't think that it's a choice. And I think that we have a lot to pray for with respect to the millennials who will inherit $300 billion. And they are saying 86% of them in the Morgan Stanley study say that they want to invest in companies that produce obviously a profit and obviously a return, but also have the right culture and the right integrity and the right treatment of their employees and their talent. So I don't think that you have to choose.
We
Sorry.
manage money for pension funds, for all the major state pension funds in the United States, for all the major pension funds in Canada, and for pension funds in Europe, for sovereign wealth funds in many different countries in the world. And all the pension funds, of course, are for the benefits of firemen, workers, teachers, state employees, and so forth. I think that pension fund managers, that is the state employees, for example, know very well that they will have to make a rational decision for the benefit of their pensioners. The question is why they keep investing in private equity if the private equity model doesn't work. I'm not quite sure if 220 is the right number, but I think the model itself really aligns the interest between the GP, the general manager, the general partner, and the LP, that is the investor and the pension funds. Because you may think about the large payoff to the GPs being, of course, many times what the state pension employees would make. But you have to remember that's a portion of the profit. And the typical model is that you pay a hurdle rate of between 8 and 12%. And before that, the GP doesn't get any cut at all. And beyond that particular point, then you get 20% of the profit. So you return the capital, you return 8 or 12%, and then on top of that, you split the profit with 20%. If I get $1 billion in profit, then my LP would get $4 billion in profit. So that's why they want to invest in private equity, because the interests are fully aligned. And if you look at the performance of private equity in comparison with, say, public market in the past 20 years, and there are all kinds of data to support it, private equity does outperform public market by about 3 percentage points over a 20-year period of time. So that's where you get your best return. I'm a private equity investor, and for my personal money, I don't invest anything in stock market. We ourselves has a hedge fund. I don't invest a penny in our hedge fund. I invest all my money in private equity. Why? That is because the public market is so efficient that to beat the market, in my view, is impossible. Some people may do it some of the time, but nobody can do it all the time. But private equity, private market, by definition, is inefficient. And therefore, you can make an outsized return in private market. That's why I invest my personal money all in private market. And I would think that it would be a mistake for a state pension fund, for firemen and state employees to put their money all in the stock market, because they might as well just invest in the index, market index. It is only in private market you can get outsized returns. And that's proven by empirical data.
So we should take some questions because we've got about 20 minutes. Yes, right here, please. Do we have a mic, or just yell if the mic is coming? And then then we'll go right behind you. And then what I'll do is I'll take a handful of questions and then we'll divvy them up.
So I'm going to vigorously disagree with George, who doesn't remember, but we were colleagues at McKinsey in the dark ages of the 1980s. And I'm going to disagree with what I used to believe 2 years ago. What you say is absolutely correct, which is that the capital markets have, in the aggregate, become the repository for people's savings. But the question is, why did that happen, and is it a good thing? So we have gone from a system which was basically pay-as-you-go, where the current generation, through the tax system, paid for the retirements of older people, and through things like ERISA, a variety of tax breaks, et cetera, we've created the fiction that in the aggregate, people can save through the capital markets. But in fact, what happens is forcing a ton of money into the capital markets does not actually increase good investment opportunities. It does, in fact, in the short term, drive up, as long as the demographics work in your favor, it does drive up the prices of these assets. It leads, I believe, to massive malinvestment. The kinds of investments in Uber and the ridiculous valuations that you see over there are largely the result of rules like ERISA, which are well-meaning rules because they want to protect self-dealing by fiduciaries, and self-dealing is less possible in the public markets. But they have distorted real investment. They have distorted incentives. So all the incentive problems that you described come out of this public policy stance that favors savings through capital markets. And in the end, we're going to discover that because the actual earning capacity, the dividends that public companies can produce, has not actually increased commensurate with the old age saving, the old age requirements of elderly people. We're either going to go back to a system which is pay as you go, tax the current generation to pay for the older generation, or worse yet, what I predict what is going to happen in 5 to 10 years is that the Federal Reserve and a bunch of these central banks are going to have to start buying stocks in the public markets to pay for the stuff, which is more or less what has happened in Japan, which is happening in Switzerland, and I predict it's going to happen in the United States, much to our detriment.
Right,
And
thank
I
you.
don't think private equity at all is a solution to this, because basically private equity gets its exit by selling back into precisely the same public markets that created the problem in the first place. So it's an extremely short-term fix, and in the aggregate, you can't solve this problem by constantly round-tripping businesses which go bad in the public markets, go to the private markets, make some people extremely wealthy, and then they go back into the private markets. That's not an answer.
Can you pass the mic to the gentleman behind you, please?
Yeah, Tom Jordy here. First, a quick comment on Buffett. Buffett advises his own family to invest in ETFs. Unless you're in the category with Buffett or with Weijian Shan, who are capable of a great deal more knowledge, I think that's where we all should be. And it's not clear to me why pension funds shouldn't be in more efficient markets like that as well. I'd like to hear from the panel on that particular question. The other particular point, it seems, I'm listening.
The Calibers decided not to have to invest in hedge funds anymore. So they would just, on the public market, they would just invest in index.
Sure, and that goes to the larger question I have for the panel, which is, I don't see where the market failures here are at all. That is, there's just a smorgasbord of choices, and it's a remarkable thing, seems to me, in our American markets, financial markets, and no one is pushing anybody one way or the other. You want to invest in hedge funds? That's fine. You want long-term investment? Find it there. You want firms that are looking critically at climate change and value investing? We have a smorgasbord of opportunities for that. I just don't see what the directionality here is in terms of a problem that needs to be solved.
Great, thank you. David, do you have a question here, a comment?
It's really a question for the panel, trying to resolve this short-term, long-term thing. Brad rightfully pointed out that in some occasions, like Uber, the market with its hubris runs ahead, doesn't seem to have any problems in investing for future profits, and in biotech likewise. But I come back to what John Kay was bringing up on day one, which is deepening uncertainty. And Shan's example of the printer, yes, if you sell more printers, is sort of if you don't sell more printers, there's a predictable result with respect to consumables. That's a risk issue, and you can more or less calibrate, okay, I know if I'm going to invest more and take the losses in printers, I know what I'll get back in consumables. And it's in the manageable category where you can put a discount rate on it and so forth. But I wonder whether deepening uncertainty isn't one reason why managers are freezing. I mean, it's a question of what Keynes called animal spirits. How much animal spirits do managers have, or do investors have, to actually allow long-term investment? So I'm just, in as much as there are people saying there's a long-term problem and others saying there's not, to what extent is uncertainty a factor that may have structurally changed what's going on that's something we need to talk about?
All right, let's take two or three more. One here, and then the lady on the right. You had your hand up? Yeah.
Oh, hi there. I come from a managerial perspective. I've worked for big corporations and myself and private equity. I have to say, by the way, I wouldn't entrust my pension to a private equity company, but that's a personal choice. Just to talk to this, I think, false difference between short-term and long-term, mostly false, and altruism and selfishness. Truth is, if you're running a company or a business, unless it's in crisis, of course you look after your people, but you also weed out the bad ones, and you try and improve the ones who aren't performing. And of course you care about your long-term brand value, but if you listen too much to the nonsense talk by marketing people, then you're going to lose a lot of money. And of course you try and maximize long-term net present value. But in a really uncertain world, either risky or uncertain, if you don't, as Professor Cornell said, if you don't take account of what's happening in the short term, you're missing all sorts of signals about what's really going on. The information you have may look, you convince yourself it's a blip, but really it's information about underlying trends. One last thing, the McKinsey thing that said that managers, 86% of managers would love to be evaluated on long-term performance. Yeah, absolutely. That's the way to avoid short-term pressures. Of course, everyone says that.
All right, thank you. Over here, did you have the mic? No. Oh, here we go.
I had a question for the panel regarding the what is the new long term? Because the rate of disruption, at least in the software sectors, and through the Internet of Things, the software is really becoming an increasing fraction of every business. It's very hard for an investor to look at long term for more than maybe 3-5 years. It's not like somebody says that they missed the 50s and the 60s. So wouldn't that be an issue to be perhaps revisited and discussed?
Right. And there was one more somewhere. Yeah, these two questions there. So sorry. Yes. And then we're going to try to divide these up and summarize them, divide them up, and answer them in 10 minutes.
Hi, I'm Richard Vermelt. I agree with Brad because he's from UCLA and so am I. There's some evidence that the capital markets can be myopic, but it's not very strong. There's pretty good evidence that they discount sort of appropriately, although there's a lot of argument on what the hell they're discounting. I mean, Cochrane says they're discounting. The discount rates are changing, and that's why you have all the volatility. The point I want to make is that the short-term issue, I don't think has to do with capital markets. I think it has to do with managerial practices. I spent a year working with IBM, and one of my projects was looking at what they called upline sales managers, which are the very top of their sales chain. These people are in charge of 3 or 4 countries. And I got at, gee, what are your strategic problems? How do you think about strategy? And I kept coming back to, boy, they are just really short-term focused. Oh my God. And I asked them, well, how often do you report sales to headquarters? They said, oh, we have to do it daily. They report sales daily to headquarters. Well, why are they reporting sales daily to headquarters? Because headquarters wants to make sure they can smooth earnings. They don't want to have any bloody surprises. Well, that's management in a big company. That's the way it works. I have a client in East Germany that's owned by an American firm, and they're on the stock market. And we had a dip in sales last summer because of something in the automobile industry, not there, but it tripped through to them. And senior management in the USA cut their R&D budget in half. They fired half the R&D people. And okay, that was their response to a dip in sales because they want to smooth their earnings. I can give you 30 examples of this. And so managers don't believe that the market is discounting properly. Now, are they stupid? Yeah, I think that's a big part of it. They're really stupid. They're not educated. They don't get how the whole system works. They're also trained this way. To get to be a senior manager, you start out hitting targets. Bang, gotta hit my target, gotta hit my target, gotta hit my target. And by the time they get to the top, they're saying, well, what's my target? Oh, it's the stock market. I gotta hit the earnings forecast. Bang, I gotta hit it, I gotta hit it. That's how you get to be a senior manager.
Can we get, can you mind wrapping up and getting
okay,
Ari
sorry.
to, let Ari ask his question,
I think the
and then
problem
we're
isn't
gonna
capital
run out of
markets.
time.
The problem isn't capital.
Okay. Ari had a question, and then we're gonna divide up and answer.
David has another question.
One comment, please. Managers are indeed deeply uneducated and stupid, so are investors.
Right. Yeah. Okay. Well, that's fine. All right. Ari, last question, and then we're gonna try to pull this all together.
We've already talked in this conference a lot about long-term versus short-term and reforming of corporate governance or aligning managers' interest with the long term and so forth. We've talked about these things. But I've suddenly realized that there is a huge part of the economy that we don't talk about, which is in fact the beginning of the future. And this is the family business SMEs part of the economy. The reason I'm bringing it up is because in China, we now have this huge initiative to upgrade the 3 million plus factories to world class. And so I've been talking to venture capitalists in China about why don't they, take a role in finding a family business that they could, the description was be a seed that you can make into a giant tree. And this is the weakness of China. These VCs who do that said to me, yeah, but I cannot just take any company. I don't know these guys. If I don't know these guys, I cannot invest in them. Okay, so that's actually a plus for the American system. But we have the same problem in Taiwan and here, that it's very difficult for small businesses, family businesses that could be leveraged to become big businesses. They cannot have access to capital. They cannot monetize their ideas. The best example are the German Mittelstand companies who stayed the family business because they could not monetize their business until the Chinese began to buy them up. And so we've not discussed how capital could flow to a part of our economy that actually could have huge potentials. And they would create jobs, and they might likely be worried about maintaining their employees and treating their employees and so forth because they started as family businesses.
Okay, so I'm going to
I think that's a topic for some other time.
Okay, well, we'll try to handle all these. Okay, so I'm going to ask each one of the four of you a question, which is based on all of these, and see if this works. I'm going to tell you what they are, and then we'll come back and ask. So, Lynn, I'm going to ask you about family businesses because people in this room may or may not know that Lynn is on the board of Estee-Lauder, which is a very well-known family company. Is a company that has evolved over time, and so maybe you can think for a second about how do some of the issues that we are talking about apply to a family company in perhaps a different way. And then, Shan, I would like to ask you about this issue about disruption, and the way I think about private equity at least is that it's time limited. You can't hold a company forever because your LPs want their money back at some point, but you don't have to worry about it every day. So maybe you could think a little bit and tell us a little bit, if you've got a 5-year fund or a 10-year fund, and you've got these issues of uncertainty and disruption, how you marry those two as you think about that. And then Brad, I'm going to come back to you on explain to us why valuations for tech are so different than valuations for, let's call them old economy companies that are also doing tech, but are part of that. And if you were part of one of those older line economies, companies that were referred to, how you would try to get value for the tech that you've got inside, even though it may or may not be making money. And then George, I'm going to ask you about pulling together this question about what is the market failure in pension plans, and is this the right way to save for retirement given the time frames that we are talking about versus the pay-as-you-go. Okay, so is that fair? Okay, and we've got 5 minutes. So Lynn.
5 minutes, that's short term.
No, 5 for everybody, not for each.
Okay. I thought 1 minute.
1 1/4.
Okay.
Yeah, 1 1/4.
Okay, well, on the family business, I can probably yield to one of these gentlemen. So Estee-Lauder is a family-controlled public company. It has gone from a $6 billion valuation in 2009 to $60 billion today. Our current CEO started in 2009, so kudos to him. We have the most diverse board on the Fortune 500. The way that our CEO transformed the company was to say that the way he thought about his management was that he was changing the engine on the 747 while it was in flight. And that's kind of David's point and your point about the short term and the long term. He had to fix some things in the short term, but he did that through a deep focus, and we understood it at the board, on the kind of products we were innovating, the markets that we were going into. We developed China during that 10 years. So, of course, you have to take care of the short term, and every manager knows that. But I hope every good manager knows that. It's like a friend of mine was on the board of Dow Jones, and he said Rupert Murdoch owns the Wall Street Journal because management was managing for the long term, and the shareholders got sick of it because it was actually just poor management decisions. You have to do both. And a family business does have, this family is in this company, they're in the 3rd generation now, they intend to be forever. So there is the advantage of the long term. I yield the rest of my time to the gentleman on my right or
All right,
left.
Brad, why don't you tell us why the tech and non-tech are valued so differently?
Well, let me do it. We talked a lot about Warren Buffett today. Let me do it with a Warren Buffett story, and I think it applies to both tech and non-tech. Suppose that you own a farm. What's your job? Your job is to run that farm as well as you can. Plant the right crops, take care of them, and so forth. And that's what you're doing. Now imagine that next to your farm is a group of people who, hour to hour, are shouting what your farm is worth. $1 million, $1.2 million, $1.4 million. What do? You don't pay attention to them. You run your farm the best way you can. You do exactly what you were doing before. Eventually, the people over there shouting will understand what you're doing and get your price right. But to listen to them and to try to manage your business based on what they're shouting doesn't make sense. Whether it's tech, like Bezos never paid attention to what they were shouting at Amazon, or whether it's General Motors today, which is an old line company. Run your business as well as you can, wait for the market to understand and get it right.
Okay, George, quick answer for the pension issue.
Right. First, this notion that we have lots of choices, so there's no problem. It's well known that markets fail when the buyers and the sellers have a very different understanding of the product being traded. So you can say, yes, every consumer can invest, let's make it up in a private equity firm or a hedge fund or the stuff I used to do in derivative trading strategies. Sure they can. So the notion that because there is something to buy, that's a solution to the problem is absurd. There's this famous paper by George Akerlof on lemons, which is a very simple explanation of market failure. Markets only work when the buyers and the sellers understand what's being traded. So I don't see the fact that there's lots of investment choices as having anything to do with whether the outcome will be good or bad. It depends on the participants, not just on the number of choices. On the other point, which is quite fundamental, I'm not implying that we should push savings into the capital markets. What I'm saying is de facto, this is what has happened as a result of the transformation of these markets into the principal channel. They didn't start out being a pension vehicle. They were a way of building railroads and conquering India. That was their original purpose. We are now dealing with a structure which isn't necessarily the one that anyone would choose. We don't have time to go into all the things you're saying, but my point is the opposite. I'm not saying it should be. I'm saying it has happened almost by accident. It's brought along all these operating problems with it, alignment of incentives, all this other stuff, because none of these things were contemplated at the time this market structure in which we now operate was created, and it's only been tinkered with and covered with legal judgments. How we should do it is a very interesting and very important question, but it's not one the capital markets were designed to solve, and they're obviously not solving it.
Great, thank you. Shan, bring us the final question on
very quickly, I'd like to make 3 points.
Uncertainty, perfect.
One is, I'll tell you what's wrong with private equity, especially with American private equity. It is when GPs, that is the general partner, charge monitoring fee, transaction fee, capital market fee, charge fees of the portfolio companies for their own benefits without regard to the interest of LPs. And the right way to do it is to give all those monies back to the LPs. That's point number one. With regard to the LP's desire for long-term or short-term, the pension funds have different needs. Some pension funds, like CPPIB of Canada, doesn't really have a funding needs. I mean, they can hold it forever. So they can be 40 years or 50 years. And they look for stable cash flow business to invest in and stay there forever. For most of the state pension funds in the United States, especially corporate pension funds, it's underfunded. So they need liquidity at any given moment. And that's something that they will have to tell us, how long that we can use their capital. And the third point, addressing Professor T's point about uncertainty. Of course, we deal with uncertainty and risks on an everyday basis. My thinking is that if you try to guess what the risk, how the risk is going to pan out, it's extremely difficult to do it. You just have to underwrite your investment in the same way consistently, so you know there's normal distribution. And if you make investment in large enough a portfolio, hold it long enough, eventually you will get that middle point in your normal distribution. You really can't second guess the market. You just have to ride out the volatilities and try to be consistent in your underwriting.
Thank you. Well, thank you all. I think Adam Smith would be proud to see a lively debate about his work, incentives, time frame, and hopefully this conversation sparks more conversations and more work in this area of trying to unpack some of these issues. So please join me in thanking our panelists.